Welcome to Markets Now. I'm Michelle Rook with Alan Brugler of Brugler Marketing, and it was an update and everything on Tuesday with the exception of the wheat market. So, Ellen, let's start off talking about corn and soybeans. We are putting weather premium in. How much weather premium do you think we need to put in? Because it doesn't look like we had very much here after being so close to these contract lows.
Yeah, I think we need a lot more weather premium if the forecasts are going to continue to run towards these mid 90s temps in the Corn Belt and short the market or short the Corn Belt on rain. Now, the 7-day QPFs suggest pretty good accumulations for the southern half of the Corn Belt, but the northern half gets a lot of 10th and quarter inch kind of stuff, and that really is not enough if you're going to have the high temps. We're getting a lot of dryness reports from parts of Ohio. That is on the cusp or the edge of the rain pattern that's in the forecast right now. But our model said old crop corn was too cheap at under $4. New crop is too cheap. If we're going to come away from those 2.3 billion bushel carryouts closer to 2.1 or 2.0 or something, that would require a lower yield. Crop condition ratings really aren't saying we need to do that yet, but you do have the funds short 300,000+ contracts. That's a very large short position, and if you're going to tighten up the supply a little bit, they probably need to cover some of those, and that's fuel for the rally.
So, with funds as short as they are, which you just mentioned, do we need a bigger weather problem, or crop ratings have to drop how much for them to start really blowing out of that position?
Well, I think you're going to have the crop ratings. We measure them by the Brugler 500 index, which is a weighted index of all 5 of the USDA condition ratings. They need to drop another 5 to 10 points on the Brugler 500 index, get them below the long-term average. Then that would suggest you're back to trend line yield or below trend. Right now, we're still above trend as far as the potential for the year. Yeah, you get below trend, then you have to drop back off of the 180 or 181 bushel estimates and start going towards 178 or 177 or something like that. The funds will start to cover, I think, if that's the case, at least if they're trading fundamentals and not just money flow.
Is that true for soybeans as well, or do we not worry about it as much now because it's an August crop?
Well, soybeans are much more sensitive to August weather than July. I am getting some feedback, particularly from the Eastern Corn Belt, that the beans are a little stressed, but we kind of expect that in July and doesn't matter as much. So they're probably going to be less sensitive to the weather forecast for a couple more weeks. But having said that, and bean meal is going to track corn to a degree, and the funds did have a record net short position disaggregated, that's futures plus options, in the last CFTC report. So, even though their position is smaller than it is in corn, it is record for beans, and therefore give them a reason to cover. There's a lot of room to go there.
Yeah, from a technical standpoint, though, we've got some moving averages we've got to get over here first in both corn and soybeans, don't we, to really run?
The 8 and 20 day today and couldn't hold it. There was still positive closes today, but again, you'd like to see them punch on through there. We've got bullish divergences on the corn. We've got on the stochastics. You've got a little of that on the beans as well. Not quite as clean of a pattern, but I like the technical action here, and actually in several of these ag commodities. So I think you have to give a little more time just to realize we're still in a short crop, long tail situation, multi-year situation. Rallies are going to tend to get kneecapped unless that weather pattern gets a lot worse.
But demand is starting to pick up down at these levels. We're uncovering some export activity and whatnot, aren't we?
Yeah, I'm liking those daily export announcements for 100,000 or 200,000 tons. That tells you that some of the foreign buyers are comfortable with this price level and that they're concerned that it might not get a lot cheaper and they need to get some coverage. Mexico has been a huge buyer in corn. They're just going to be there. But what you want to see is the Japans and the South Koreas and those folks stepping up and buying more quantity here. And we're starting to see some of that. Also, some unknown destination sales. So, the combination of a little bit more weather concern and some better export demand, along with pretty solid domestic use for ethanol and things like that, you can justify holding the price here, or maybe getting a little bit of a correction going into August.
Yeah. Corn demand, though, better than soybean demand. We've saw a few new crop sales from China, but we're behind, aren't we?
Yeah, China has purchased very, very little new crop corn compared to what they usually do. If you look at a new crop commitments table just for China, it's still the worst in the last 10 years, even going back to the trade war situation. But speaking of trade war, that's kind of an interesting angle because certain political commentators are concerned about adding tariffs or getting into a tariff war after November. It would not have a whole lot of impact right now because China has bought very few beans for shipment after the 1st of October. So, in a way, a light commitment is good. It's forcing that business to go to other countries right now, and probably more stable sales in that regard.
So the wheat market was not able to follow corn and soybeans into the close, nor was it able to extend gains. So did we run it to chart resistance? Was that the higher dollar? What was going on there today?
Well, strong dollar doesn't help us. You have to remember that from a global perspective, a lot of the world wheat production is in the northern hemisphere. So, this is very close to peak supply globally for wheat right now, because Canada, U.S., Europe, Russia, Ukraine, etc. You got peak supply. The Russians dropped their export tax considerably through the end of the month. They're trying to buy some export share. Their crop is down, but it's still they still have quite a bit they want to sell in the first 6 or 8 months of the marketing year. So, they're putting the pressure on here. Uh, we've managed to get some short covering and get a little rally going in the wheat. And Minneapolis kind of led us yesterday, and the day before. But the big story is can you get buyers outside that Russian influence?
No doubt. Cotton market has had a steep slide since being over $1 with the March highs. I know we're looking at new crop now and bigger supplies and better conditions now, but do you think there's a lot more downside risk in that market or not?
Well, cotton, the loan rates are still well below where we're at. Of course, that's true with corn, beans, and everything else. Those things really need to be raised in the next farm bill. But so you can't really say there's a floor here. I think 2 or 3 cents would be pretty cheap, given what we've already seen in terms of price decline. But what's the story? You've got increased carryover supplies. You've got better crop condition ratings. You've got moisture on some of that dryland cotton that's really going to help it out here. Uh, the market also needs to see, I think, some better consumer demand. We are still seeing the consumer pretty squeezed from an inflation standpoint. The stuff they have to buy, they're paying for, but cotton, new clothes are probably low on the list of priorities, and that's going to impact you on textile sales.
Yeah, it's squeezing from both sides. Let's end up talking about the cattle market. A nice update here today. Is that market just anticipating that cash trade is just going to continue to hold together here?
I think the market is saying as long as the cash trade holds together, then the board's too cheap, right? You do have 6 weeks or so until August goes off the board, so there's no rush to convergence. There's no delivery mechanics here. The first event there would really be the August options expiring the first week of August. But I think the market's saying if cash is going to be at a premium, and there's definitely a premium in the northern plains, in the northern market, South is kind of driving the futures, but even there, you've got a little bit of premium. So, you know, cattle and feed report was neutral. You've got good technical support in terms of rising regression channel and moving averages. Market kind of tested that last week and bounced off of it. So, you know, we are comfortable going up a little bit today. I don't think this rope is very long here, simply because you have to see that the consumer is going to continue to pay up for the beef, and the packers are struggling to buy enough cattle. There just aren't that many out there for sale. So uh, they're paying up whenever the consumer's buying the beef. If they're back to back in it, margins are positive, but they're pretty tight.
No doubt. All right. Thanks so much. Ellen Brugler with Brugler Marketing. That is Markets Now.